Hello, and thank you very much for joining us today in the latest of our series, Dolfin Discussions, where we are going to be looking at equity valuations, the new abnormal. And I have invited my colleagues, Simon Black and Mikhail Trebunskikh, to help us unravel what I think is one of the great mysteries of the universe, which is, do equity valuations make sense anymore? In a world where equity prices keep going higher, and yet we're in the midst of the deepest recession in living memory. And what do equity valuations mean for our investments? Let's just dive right straight into it. Simon, in a world where interest rates are zero, even negative, one of the arguments I hear is there's no alternative, Tina. So maybe valuations just don't matter. Maybe Tina, maybe there's no alternative. What do you think?
I think there's a couple of different aspects there. One is, as you said, lack of suitable alternatives to be investing into the current market environment. We've seen a lot of central bank activity over the last 8 to 10 weeks in terms of cutting rates, bond yields coming down. That's kind of forced, I think, to some extent, a lot of investors into equities. We were talking about this idea of, do valuations matter? Do people care? TINA is one acronym. The other one that I've been using a little bit more recently is the concept of FOMO, fear of missing out, the sort of rally that is one of the sharpest rallies that we've seen for many years, coming right off the back of, if not record declines, but some of the fastest declines that we've seen. And I think people are so focused on the last couple of weeks and not wanting to miss out when equities are going up, and as it kept kind of going up and increasing and further, as opposed to standing back and saying, does this really make sense, buying S&P 500 at 19 and a half plus times forward earnings at a moment when we are going into this deepest recession, and at the same time when we're seeing earnings being adjusted? I think that last bit is something that so many people miss because they're so focused on the here and the now rather than the standing back and having a look at the bigger picture.
Yeah, I think you're right. I mean, I think people have reasons for buying into equities that aren't always related to sort of careful analysis of how those earnings translate into fundamental value. And you mentioned FOMO, and I think you're absolutely correct. There's another example which just pops into my head. It's very topical. So we know that the Swiss National Bank defends the Swiss franc, and they try to keep it from appreciating too much. Whenever you have a risk-off moment in the markets, the Swiss franc appreciates, and so severely. And so anybody in Switzerland who actually produces a good or a service finds themselves incredibly uncompetitive because of the exchange rate thing. So the Swiss National Bank basically prints francs in whatever quantity is needed to sell the francs and acquire the dollars or the euros that are being pushed into Switzerland. A few years ago, what they did is they started, and very explicitly, taking those dollars that they would acquire, or those euros that they would acquire through this money printing exercise to keep the franc from appreciating, and they would buy into equity indices. So I don't know what the exact number is. It's very hard to kind of suss out, but certainly maybe on the order of $100 billion during this most recent risk-off fright went via this Swiss exchange rate defense mechanism into the S&P 500. And the Swiss aren't buying it because they're doing an analysis of S&P earnings potential. Is it value? Is there growth here? They're buying it because they have dollars that they acquired defending the franc, which they have to do something with, and so they're putting it into the equity market. People buy equities because there's no alternative. People buy equities because they're afraid of missing out. People buy equities because they've acquired a large chunk of dollars in the process of defending their currencies. None of this has anything to do with actual valuations, which I find, somewhat perplexing as a person whose job it is to try and figure out what things are worth and then put it into an investment.
But I'd say, James, the concept of valuations, if we just for a second switch asset classes and we look at bonds with negative nominal yields,
Right.
I think you can have exactly the same conversation a few years ago in Europe in terms of who in their right mind is buying negative yielding German government bonds.
Well,
And
not
that
us.
was, I'm sorry?
Not us.
No, definitely not us. But in terms of, you kind of look at insurance companies, pension funds, it was not a valuation decision in terms of I'm not going to buy this because I think I'm going to get a good return. It was I have a regulatory requirement to be invested to X percent. Similar sort of argument for the
Right.
S&P in terms of I've got dollars that I want to deploy into equities. And we're looking at this from the position of who the biggest buyers of equities over the last few years. It's been companies buying their own stock. We've
Yep.
seen ETF assets sort of swelling up massively. What's going to happen going forward? Are we going to see less company buybacks, but more central bank buybacks or buy-ins, so to speak?
Yeah, no, I think you're right. It's funny that you should mention bonds, because one of the questions that's sort of in my head right now has been for a while is how we sort of reconcile zero or negative yields on government bonds with equity valuations. And Misha, this is something
Yeah.
we've been talking about in the past.
Yeah, so basically, if you think about how the valuation how this policy will affect valuation, we can first just highlight several points. So first, actually, once you're approaching kind of extreme levels of interest rates, your valuation metric become really sensitive towards little tiny changes. So meaning that it's very difficult to put like 100% emphasis on this one particular valuation metrics. So because of as simple as like tiny move can move your expected price for particular stocks just higher or lower, and just
So the lower interest rates go, the more the
yes.
impact on the price multiple is for a small move in rates.
Yeah, and also if you think about stock performance over the last decade, so it was driven by multiple expansion, but inflation of the multiples, and it was driven by central bank interest rates policies. So, but as long as we're approaching kind of not end, but in some countries it is kind of looks like already we approached negative territory, but in some countries we just staying nearby. So in this case, it's very difficult to rely on this particular driver. And
so a lot of the PNs are, so the multiple expansion has been driven by declining rates. Now that rates have declined, not just in Europe, not just in Japan, but also in the US to zero, even negative. Is there a lower bound, Simon? I mean, can rates just go negative to negative infinity and continue to inflate the multiple?
The interesting thing, if we kind of think of ourselves as both three consumers and three investors, cash that you have in your bank, at the moment in the UK, we've been getting some appreciation from the bank for storing our cash there. At some point, as we've seen in increasingly more European countries with some of the European banks, at some point you have essentially what you can kind of view as a storage charge for keeping your cash with them, which is the negative impact rates. You can see where I'm going with this, James, given the conversation we've been having about storage costs and how negative can oil prices go. And the interesting thing for cash is if I'm being charged to keep my cash with the bank, what other options do I have? One of the options is to buy equities, contributing to higher valuations perhaps. The other one to buy government bonds, except you get to the point where bond yields become almost as negative. The other sort of extreme angle, which is going to provide your floor from a negative interest rate perspective, is how much does it cost to store cash? And not a few £1,000s you can store at home under the mattress, but if you're talking a significantly larger sum, then you might be looking at how much does it cost to rent a bank facility, sort of locker, storage box to put the cash in there. So it's going to put some sort of...
How much does it cost? Give me a bound, roughly.
Well, from that perspective, depending on size and size of box and quantity, 50 to 75 basis points. However, the issue is limited number of storage spaces.
All right. So, I mean, and I'm coming at it from a guy, who's been looking at commodities markets for a while, if there's a storage trade here, they'll build the vaults. So okay, so at 50 to 75 bips, I'm thinking to myself, you know what? I build myself a great big vault. I take extremely large denomination euro notes or US dollar notes, and I just put them away, and I get paid for it. It's a risk-free trade, and that makes a lot of sense. So there is a lower bound here. You know, that this boost to the price multiples, I don't think is going to be there as we go forward from further declines in rates. So let's keep going then. I mean, what are some of the other valuation sort of drivers in this new abnormal? I mean, one of the things that comes to mind is we've been looking at tax cuts in the U.S. Tax cuts in the U.S. In 2018, the Trump tax cuts provided an immediate uplift to U.S. earnings estimates. In fact, I can show you a slide which we prepared before coming online. And you can see right here, this is the evolution of earnings estimates for both the S&P 500 on the left-hand side and Euro stocks on the right-hand side. And if you look at 2018, you can see there's this like nice little cliff where U.S. earnings just push higher. That was a Trump tax cut. So corporate earnings were boosted because they had to pay less taxes. And you know that persisted. But I look forward right now, and I think as governments are pushing borrowing to record levels, there's no way taxes can continue to be cut. They're gonna rise. So Misha has told me, you know, quite convincingly that Misha has told me that quite convincingly that you know, in this negative or zero or negative interest rate world, we're not going to see the multiple expansion that we get from declining interest rates because they, as Simon said, they just can't go below 75 basis. Tax cuts aren't going to boost earnings metrics anytime soon because we've just been borrowing to the hilt to try and get through this recession. What are some of the other kind of drivers that we need to be thinking about as far as earnings that we could potentially use in valuation in the new abnormal?
So basically, it's interesting because of if you look at the market performance in 2019 and since the beginning of this year, I would mention that it's been quite concentrated and it's been driven by large cap stocks, and actually these stocks, they already been expensive according to the kind of traditional price to earnings multiples. But the thing is that it's been quite a while. It not happened just this year or last year. And we, I think, need to divide market into several parts. So first of all, high price to earnings ratio could be due to the fact that actually it's a declining industry. Earnings been revised, and the market analysts thinking that actually for company it's not will be not possible for particular company, let's say some tourism related company or airline to go back to normality which used to be before the global pandemic. And this is a structurally declining industry, and it could take maybe 5 years to recover. But from other hand, it could be some companies, let's say Amazon or other information technology company, which can use this crisis as an opportunity to increase their market share. And this
okay, so
yeah,
go ahead. No, go ahead.
Yeah, and the high price to earnings ratio actually may be due to the high earnings potential in several years. So
okay, so the fact is that not all companies are the same, that you've got Amazon's on the one hand and you've got Carnival Cruise Lines on the other, and they just have really different outlooks going forward. So it's not just about the high level valuation issues, bond yields or whatever, or even tax rates. It's about specific industries and specific businesses and how they work. That makes sense. But I'm still gonna pull it back here. Earnings are very, very closely related to GDP. I mean, from a basic level, if you think about all of the output in an economy like the U.S. economy, ultimately that output is taken in by incorporated entities, by corporations. That becomes their revenues, that becomes their profits. So the gross domestic product of a large economy like the U.S. is approximately equal to the sum of all the profits for all the businesses in the economy, with a lot of nuance and caveats. So earnings are closely related to GDP. But right now, nobody's got a clue what GDP is going to look like. Is it V-shaped? Is it U-shaped? Is it W-shaped? Is it L-shaped? I've even got a guy who says it's I-shaped. It just goes down, and then like the world stops. I mean, I don't know. That seems a little bit strange. But we get these weird things going on in the stock market. So we were having a conversation earlier today, guys. Over the past 8 years, U.S. corporate profits have basically been flat, have effectively not moved higher over 8 years. And yet the U.S. stock market has risen by something like 85% over the same period. How do I get there? How do I get from no earnings growth, no profit growth for the economy as a whole, to almost doubling in share prices?
Right. Can we challenge you to put that graph back on the screen, the last chart? And
if I can figure out how to manipulate my screen, I'm
exactly.
not the world's best when it comes to managing all this.
I just wanted to highlight one thing before Misha chips in with what we'll call the real answer. I mean, that worm chart shows the sort of ongoing optimism of analysts that sort of every year you start higher and it slowly gets downgraded as we sort of work our way through to and during the year. Just wanted to highlight the fact that the earnings expectations increasing from an EPS basis year on year when earnings have been flat. I mean, that is, and one of the huge differences between the US and Europe is buybacks. I mean, that's very, very obvious in that regard.
That's a really good point.
That's one of the sort of big skews from the US perspective in terms of a lot of CEOs of these large publicly listed companies are remunerated based on an EPS basis. When we've seen very, very low interest rates, we've seen a huge amount of corporate debt issuance and then using the proceeds of the debt issuance to either pay dividends or buy back stock.
So corporates increase leverage massively, taking advantage of extremely low interest rates to buy back shares. Yeah. I mean, are they going to get away with that in the next couple of years?
Well, that's the interesting thing, because A, some of them are not going to be allowed to do that. But B, when we're going to see a lot more differentiation going forwards between companies that actually have the balance sheet to continue with the dividend payments or the share buybacks, because we've already seen some of them being suspended on both fronts.
Yeah.
And I think, just looking at the sort of cliff face that you mentioned that we've started falling off, I mean, the big question from my side is how low can we go on the S&P side? Do we break through 120? Do we break through 100? How far can those re-ratings happen? And that's the sort of the big unknown at the moment. But whilst that's happening, that's just going to skew that valuation argument even further to another extreme, unless there's a sort of either a decoupling with the stock market or the market corrects as well.
Yeah, no, I think that's a really good point. And one of the things that you can't see from a chart like this, but it's that the dispersion of analysts' earnings forecasts is actually higher than it's been in ever. It's extremely high. I don't know if it's the highest in history, but analysts are extremely uncertain right now about just how low earnings will fall in 2020 and 2021. And you're right, you're absolutely right about both dividends and share buybacks. Already, I think something like 200 billion of anticipated share buybacks have been canceled this quarter, and we've also seen a record number of U.S. Equities cancel or pause their dividends or reduce their dividends payouts. And we've seen the same thing for Europeans. I think it's a third of the Euro Stoxx 600 have have cut their dividend forecast, their dividend payments. And it's really important because I think a third of the total return of 500 is reinvested dividends. So, right. So tax cuts are good for valuations, but those aren't going to happen anytime soon. Dividends are good for earnings and thus valuations. Those are going to be cut. Share buybacks, yeah, it doesn't look like we're going to have that much success in having a broad-based share buyback kind of environment. So this all makes it very, very difficult in my mind to value equities in this new abnormal. So I don't know. So what should we be valuing? You know, how do I invest? I mean, you go from here.
So basically, I think that you need to assess company from different perspectives, not only just put a huge emphasis on one particular number, because again, the number could be misleading. But what happens that actually, as I already mentioned, that these US large cap stocks, particularly like Microsoft, Amazon, they've been actually prepared for this crisis in a way that actually they have a strong balance sheet to survive. And eventually, if the other company will go bankrupt, they can acquire their market shares. And also, like, let's say, if we're talking about these companies, they have very high barriers to enter. It's also could be reflection of this kind of high multiple. So basically, I just saying that you can't just take one number and just saying this company expensive. That is why I'm not buying this. No, actually, it's
okay. I hear you. So what you're telling me is that we're moving into a stock pickers universe. Is that what you're
Yes, absolutely.
All right. I've heard you say there's a particular word I've heard you say at least 2, maybe 3 times today, and I hear in this conversation, and I hear you say it all the time. Walk me through one example, and let's talk about Amazon.
Yeah, so Amazon is a perfect example. So because if you look at the price to earnings ratio 12 months forward, you never bought this because of it never been at the levels which ordinary people looking for as a reasonably price. So basically, it's been staying in a range of 40 up to 100 for the last 10 years. But actually, it's the worst investment decision not having these stocks in your portfolio because of return was incredible. And I would argue that this price to earnings ratio of let's say 70, actually, it's not about the next year. It's about ability the company to increase their market share. It's about growing e-commerce penetration out of the whole market. It's about also building some barriers to enter this industry. So, for instance, Amazon have a perfect logistics at the moment, which allows them to cut the cost to deliver goods and goods, and also deliver this within 1 day within their premium service package. So it's about different. It's much, I would say, broader discussion rather than price to earnings ratio. And I would say that it's particularly important to be focused on this type of companies and in particular industries in the new post-COVID-19 economy, because of otherwise you can end up with index. And also one of the things that actually I would expect that the structure of the index will be absolutely different compared to the one which we have at the moment.
So there are some people who are going to drop out of the S&P 500?
Yes, absolutely. Right. Because yeah, absolutely.
So we've been sitting here worrying about whether or not valuations make sense anymore, and how you can come up with a valuation and how you can turn that into a PE multiple. And what you're telling me is that we need to put at least part of our attention onto other factors that are very idiosyncratic to a specific name. So maybe Amazon's a great example. I think what I'd be much more interested in doing right now is finding the next Amazon. so that we could go ahead and get in
Yeah.
early.
So
I mean, that would be the trick, wouldn't it?
Can I just follow on one thought on what Misha
Yeah.
was saying, and this is important from an index perspective. Amazon with a PE of 70 exists because people are so convinced by its growth potential. Plus, there was the thing of Amazon that it was using a huge amount of its revenue on research development, rolling out its logistics arm in Europe. So although it had a PE ratio of 70, it could have been less if they were allowing more to flow through to the bottom line, but they were focused on building. Now, if you kind of take it to right now, when we say Amazon's at a PE of 50, there are other companies that we can find in the S&P 500 with PEs of 50 as well. The danger is, are they at a PE of 50 because the stock price has rallied up because people are so convinced in the future of the business? Or are they at a PE of 50 because the earnings has come down so far that hasn't yet been reflected quickly enough in the stock price? Because it's one or the other. And this is kind of the danger when we're looking at things from an index PE level, that you see some energy names that have huge PEs because they've got very, very little earnings. And so when you start to sort of step back and you're looking at, okay, well, what am I buying when I'm buying the index? I'm buying a little bit of every underlying component and their respective earnings depending on the weighting on their market cap. So what we're kind of looking at from the perspective of, looking at the S&P 500, do I want to buy Norwegian Cruise Lines? Do I want to buy Carnival? Do I want to buy Delta, United, Boeing? There's sort of a whole host of companies that maybe you think, I don't necessarily want to hold them over the next, not just 2 to 3 weeks, but 6 to 9 months, because we're all on this, what's going to happen next? But they're all, every single one of them is contributing towards the index level PE.
So we're sitting here trying to analyze S&P 500 PE ratios, and those earnings are a combination of Amazon's, where a lot of the earnings are great, and a lot of it's actually being funneled back into growing the business and building out, the future prospects that Misha's been talking about, and then some of it's just because their business is absolutely cratered, and you can't get people onto a cruise ship for love or money. Okay, so I don't think buying indices makes much sense anymore.
absolutely.
That's going to be difficult, yeah.
I also would mention that if we're moving towards negative interest rates policy, the return on investments in these markets, and we've seen already that in Japan, it's a good example. So just it's so low, and it's very difficult to just sit and hold the whole market, because of by doing so, actually, you just encourage some companies, not maybe such an effective companies, to borrow and just continue to do something which may be not really on demand. And
zombies. You're talking about zombies.
Zombies, absolutely. And overall, it because of index, what is this? It is just average figure, average number. And for this, it doesn't make sense to hold the whole market, because if you want to have only good companies, not these zombie companies.
So, all right. So, you're talking about zombie company, and I hear you. I think you've made a very convincing argument for why we need to be a little bit more stock picker in our approach. But I can't. We keep talking about zero rates, dudes. Guys, it's this return. Whether it's Japan and their ZIRP going into a NIRP, zero interest rate policy, into a negative interest rate policy. We've seen the same thing with Europe. These have not been really good stories for either of them. And now we're looking at this with the U.S. So part of the answer is we need to look past traditional valuation metrics, and start getting a little bit more single stock focused as far as what we look for. But we still need to make that longer term decision, or that broader decision about how we should invest. I'm sort of struggling here with how we thinking about equities versus bonds in this world where bonds are pushing zero. I mean, Simon, isn't this what you do for a living?
Or try to. It's getting harder as we're all getting older, and bond yields seem to be getting lower. I think one of the important things for me, and we can look at this from a pre-COVID-19, post-COVID-19 lens, and it's kind of coming back to the asset classes in terms of, do you want to construct a portfolio through a combination of fixed income and equity? Do you want to construct a portfolio from a combination of income versus real return? Every individual component of a portfolio has to kind of earn and justify its place in there. We took a decision that we didn't want to buy any negative nominal yielding bonds. Now, when we're looking at the European bond market, that gets incredibly difficult because it rules out essentially most of core Europe and anything that's kind of not ridiculously long dated. So you kind of end up in a position where different parts of the market actually are no longer I don't want to say permitted investment, but from my perspective, a sensible investment. You're trying to look at things from the client perspective in terms of what do I want to own over the next 5, 10, 15 years? How can I generate a real return for these portfolios? We had to go through this big reallocation process on the fixed income side because of events in March, and nothing to do with equity declines and concerns over bankruptcies, and all to do with central bank interest rate cuts and the sort of subsequent impact on yields and rolling short-dated government bills into short-dated government bonds. We've been having the conversations as a team in terms of, well, is high yield or equities better from a risk return perspective in the current environment? If we look back over the last 30 years, we've seen the US 10-year yield consistently get lower and lower and lower. And we've kind of moved from a world of being able to buy a government bond where it can contribute 4, 5, 6% or a heady 8 or 9% back in the early 90s to today where it gives you less than 1%. And that's pre-fees, pre-inflation. So when we're kind of looking at things from, and I don't think it's any surprise to see how these lines will be getting further apart, then there's a part there of the less that you can get in the fixed income space. You either have to take investment grade credit risk, high yield credit risk, or you kind of end up getting skewed towards equities.
You're back to Tina?
I think, Tina is a huge contributor to what we're seeing at the moment. And although we're kind of on the investment side, no action is an action in the sense that every single action you take, you have to be able to look back at and justify. Buying S&P 500, buying any index where you're paying 19, 20 times forward earnings.
Just on this chart right here that we've got in front of us, I mean, we've got, the S&P on the forward PE ratio right now is back to like January 2002.
Yeah, .com bubble.
Biggest recession in living memory. And really?
And I think the scary thing from my perspective is none of the three of us know how the world is going to look in 6 to 9 months' time. And you're paying £20 for expected £1 of earnings or $20 for $1 of earnings, but we don't know how it's going to look in 6 months. We don't know how quickly the world is going to be unlocked. Having seen it locked up very quickly, we don't know how quickly consumers are going to come back. We don't know how quickly the unemployed are going to be re-employed. Coming back to your dispersion point, James, which I can finish on, then I'll let someone else get a second to speak. One of my favorite items that I was looking at was when we had the first big week of initial jobless claims. Then we were kind of coming up to the second week. And in terms of the spread and of forecasts, the breadth of the spread of jobless claims was a multiple of what had been the previous high.
Yeah.
And I know we kind of then subsequently hit multiples of multiples, but it kind of indicates the fact that when we're looking at earnings, when we're looking at macro data, nobody knows how bad this is going to get. And
one of the arguments that I've seen in the past, and I think this is also somewhat compelling, is that, in recent years and decades, with the exception of the 2008 financial crisis and global financial crisis, the volatility of macro data has gone down. So GDP has been less volatile. Inflation has been less volatile. And so as you reduce uncertainty, you make it easier for people to buy equities or to hold risk assets. I mean, if I live in a world where tomorrow is more predictable, I'm more comfortable taking risk because it's less risky. I think the dispersion that you're talking about highlights that looks like a bit of a thing of the past. I mean, we don't know how this world is going to look in 6 months for all the reasons that you've gone through. And to which I would add what Misha was saying. We don't even know if some of these companies are still going to be viable members of the broader indices. So I think that uncertainty is also, a really important point. And just to sort of add to the comment you were making, where we're looking at the chart with the Treasury 10 years down around 50 bips and the S&P forward PE ratio around 20. I mean, the bottom line is everything's expensive.
Absolutely.
On a 100-year basis. Equities are expensive on a 100-year basis. Bonds are expensive on a 100-year basis. So in order to find something that's worth owning when everything's expensive, you're going to have to be very selective. That's kind of what I come away with. Guys, have we covered everything? I mean, is there anything that remains to be discussed?
Have we answered the unanswerable question, is what you're asking?
That great mystery of the universe, the meaning of life or of equity valuations. I don't know. I think one of the things that we're coming away with is that passive investments are no longer the ticket, and that it's going to be a lot more about selection and probably a little bit about timing as well. So it's going to require a bit more active management, and that you're going to have to be, as Misha was saying, you're going to have to be a little bit more flexible. You can't just blindly churn through numbers looking for some combination that has worked historically. You're going to have a story. Amazon had a story, and that's why you bought it.
Just to take that thread one step further, in terms of people have historically been kind of looking at things from a top down or a bottom up when you're kind of combing through fundamental analysis, trying to find a company that's undervalued, or sort of top down asset allocation decisions. We're sort of in this in between world now, where we're seeing huge changes in consumption habits that have kind of been imposed on us. And then part of the drivers being, well, how quickly do we revert? How many of these sectors, restaurants is one example, how many of these sectors have to wait how many more weeks or months before they can see any revenue coming back? So it's not just a top down, do I want equities, do I not, or a bottom up. How do you value a company when you don't know when it's going to be able to reopen? I can tell you what the revenues of some of those companies are, 0 for the last 6 to 8 weeks. Well, what are they going to be in the next 6 to 8 weeks, the next 6 to 8 months? And that kind of comes back to this issue that fundamental valuations are almost impossible. Top down, trying to make big, bold decisions is going to be very, very difficult. So, your concept of being nimble is bang on.
I think
I would also thinking about the market structure, because of some of these companies, they really can go bankrupt because of when first lockdown's been announced, the government just announced that, okay, so we can save everything, but it was just the underlying rationale was actually we're just sitting under like lockdown for a couple of weeks and go back to the old world. But it seems that it will be new world. And what is the point for government to save like all airlines? Like why?
Some companies going to have to go bankrupt. I mean, that's what happened.
Yes, absolutely. So so maybe the largest flagship government have stake on this airline could be saved. Okay, but it could be one company. But what about the whole industry? So yeah,
you can't save every airline.
Absolutely. Yeah,
I mean, just to kind of wrap things up, because I know that we've got to put an end to this. one of the things I do think that what we're talking about here is a blend. I mean, you know, Simon, you're right. If you're just relying on top-down allocation decisions, I think you're going to be disappointed with your performance over the coming 5 to 10 years. But conversely, I think you need to be nimble, to use your word again, about your strategic and asset allocation decisions, and within that framework, you need to be smart about the specific names you put in. So it's both top down and kind of bottom up, meeting in the middle. And I'll tell you, one of the things that this tells me is that there's going to be more of a premium on people who can kind of think through a narrative or a story, as opposed to sift through historical data. Great, guys, that was really interesting. Thank you very, very much. And thank you as well to all of our clients and our friends who have joined us for this video conversation. So we've got some upcoming videos that I just want to highlight for you. My friend Simon is going to be doing another one in his Beyond Coronavirus series on emerging markets. Has the emerging market consumer engine run out of petrol? So that's coming up. I've got one that I'll be doing shortly with our friend Charles Dumas at TS Lombard, and we will be talking about how to make sense of macro data when the data doesn't make sense, which I think is quite related to the conversation we're having today. And then we've also got another update in our Beyond Coronavirus series where we'll be taking a look at how our coronavirus basket deployment is coming along. So again, thank you very much. If you have any questions or if you need any further information, feel free to email us at marketing@dolfin.com. You can visit us at dolfin.com/research. And we invite you to follow us on a variety of social media avenues. Thank you and stay well.